A hotel's operation rests on three pillars: front office, housekeeping, and food and beverage. Today, we focus on the kitchen's finances. The ultimate metric of a kitchen's success is its prime cost, combining the cost of raw materials with labor. To track this accurately, we translate physical movement into financial data. When raw ingredients leave the storeroom for the kitchen, physical inventory drops and food expenses rise. The standard journal entry here is a debit to cost of food and a credit to food inventory. But this entry cannot happen in a vacuum. Without a formalized source document, like a signed store requisition, to trigger the entry, the kitchen's performance metrics are completely fictional, setting the stage for operational chaos. This chart tracks the monthly food cost percentage for Hotel Victoria. As you can see, their costs inexplicably spiked from 35 to 45% in a single month. To find the leak, the accounting team has to audit the physical inventory records directly against what was actually produced in the kitchen. The audit revealed a major operational blind spot: the void. When a guest complains about a meal, front-of-house staff often cancel the order in the point-of-sale system. They assume the problem is neatly erased digitally. But the physical reality is entirely different. That meal was already cooked and must be thrown away. Those ingredients are permanently lost, even though the POS system reads $0. This specific discrepancy creates a massive loophole for fraud. A staff member can collect cash for a valid sale, void the digital transaction, pocket the money, and hide the stolen amount inside the kitchen's general cost of food numbers. Relying entirely on the POS system without reconciling physical waste makes the kitchen look highly inefficient, and worse, it actively shields internal theft. Let's put you in the role of the cost controller. You hold an authorized void form signed by the manager on duty for a ruined meal worth 100,000 rupiah. You need to record this loss without unfairly inflating the chef's cost of food metric. Pause the video right here. Grab a piece of paper and write down the exact journal reclassification entry you would use to solve this. Here is the logic. That 100,000 rupiah cost must be actively extracted from the general food cost pool and isolated into a dedicated penalty account. The correct journal entry to fix the void anomaly is a debit to waste expense for 100,000 and a credit to cost of food for 100,000. This specific reclassification matters to management because it proves the cost spike was caused by front-of-house guest returns, clearing the kitchen of any inefficiency charges. This vulnerability, the gap between digital tracking and physical reality, applies to every revenue center in the hotel, not just the kitchen. If housekeeping loses a batch of physical towels, that must be reclassified to a linen expense. If the front office deals with unpaid corporate invoices, that moves to bad debt expense. All of this is governed by the objectivity principle. No journal entry can ever be recorded in a hotel without a verified, signed source document. To summarize food and beverage, memorize these two steps. Standard production requires a debit to cost of food and a credit to food inventory. A void correction requires a debit to waste expense and a credit to cost of food. Disciplined accounting procedures and authorized source documents are the only true defenses a hotel has against profit leaks and operational fraud.